Ever wonder why a store making $10,000 a month online can still leave a business owner with absolutely nothing in their bank account?
It's a terrifying reality for a lot of people.
It really is.
Okay.
Welcome, everyone, to the EXMON podcast and to this deep dive where we are getting into the real, just the unfiltered math of e-commerce survival.
Yeah, it's not what people think.
No, not at all. Today, our mission is to unpack the dark side of modern retail. We are looking at how the market giants have essentially engineered themselves to operate as financial vacuum cleaners, just quietly siphoning off your profits while selling you this dream of independence.
Right. It really is a profound shift in how retail infrastructure works. I mean, for the last decade or so, we've been sold this illusion of sauce freedom, right? Software as a service.
Right, yeah.
And the pitch is incredibly seductive. You pay a supposedly small monthly fee for a digital storefront, and suddenly you're a global merchant. You're ready to take on the world.
Just a few clicks and you're in business.
Exactly. But the reality in the source material we're looking at today, it reveals this just a labyrinth of hidden fees, aggressive penalties, mandatory subscriptions. If we connect this to the bigger picture, platforms like Shopify, they've built these closed ecosystems where they get paid regardless of whether your business succeeds or fails.
Wow. Yeah, they get theirs either way.
They absolutely do. Contrast that with platforms like EXMON Bazaar, which is emerging as a highly profitable alternative for small businesses precisely because it abandons that subscription-heavy model. It favors actual aligned incentives.
Exactly. It's the difference between having a business partner and having a really aggressive toll collector just standing at the door of your shop.
That's a great way to put it.
Okay. Let's unpack this by looking directly at the mechanics of this revenue drain.
Yeah.
Our sources outline 7 specific hidden fees on Shopify that just catch merchants entirely off guard.
Yeah, they really do.
But let's not just list them. I want to understand how these platforms have structurally designed the system to bleed margins. Let's start with, I guess, the most basic function of a store, right?
Yeah.
Getting paid.
Yeah, getting paid. That is where the most persistent drain begins. So payment and transaction fees. On the surface, the marketing materials, they highlight a base rate.
Okay.
It's typically 2.9% plus 30 cents per transaction if you're on a basic plan.
Right, which doesn't sound terrible at first glance.
No, it doesn't. And if you are selling a $1,000 sofa, that 30 cents is negligible.
Sure.
But let's say you sell a $10 phone case or like a $12 candle. That 30-cent flat fee suddenly represents a massive chunk of your margin.
Oh, I see.
When you combine the percentage and the flat fee on a low-ticket item, you're looking at an effective processing rate of nearly 6%.
Oh, wow. Which is incredibly punishing. You're losing 6% of the top line before you've even paid for the product or the packaging or the shipping.
Exactly. You're in the hole immediately. But what's fascinating, and frankly a bit predatory, is what happens if you step outside their preferred system.
Okay, what do you mean?
Well, the sources highlight something called the third-party gateway penalty. Let's say you cannot use Shopify's in-house payment processor.
Why wouldn't you be able to?
Well, maybe it's not available in your country. Or maybe you sell a perfectly legal product that just happens to be in a restricted category, like certain dietary supplements, for example.
Oh, gotcha. Okay, so you have to bring your own processor.
Right. Because you are forced to bring your own payment gateway, Shopify penalizes you. They tack on an additional 2% fee to every single transaction.
Wait, just to clarify.
Yeah.
They charge you 2% on top of whatever your own payment processor is already charging you, just for the privilege of routing the money.
Precisely. It is literally a toll for not using their proprietary system.
That is wild.
Yeah. And if you are selling internationally, which, is kind of the whole point of e-commerce, you get hit again. You can expect another 1.5 to 2% to vanish in currency conversion fees.
So just to recap the math here, if I'm an international seller with my own gateway, I could be losing 5, 6, or even 7% just on the mechanics of moving the money from the buyer's credit card to my bank account.
Yep, that's exactly right.
That is just wild.
It is, and that's just the payment layer. Now we have to look at the infrastructure layer, which brings us to app subscription bloat.
Okay, I've always wondered about this. When you sign up for a platform like Shopify, doesn't it come with everything you need? Like, isn't that the point of the monthly fee?
Not at all. And this is by design. The core Shopify platform is essentially a bare bones framework.
Oh, really?
Yeah. To get standard modern e-commerce features that consumers just expect today, like product reviews, advanced filtering by size or color, or multi-currency support, you have to install third-party apps.
Ah. Ah.
And merchants fall into what the industry calls the free trial trap.
Oh, let me guess. You install an app for a 13-day free trial to see if it helps your store. You get busy running the actual business. You forget to cancel it. And suddenly it's hitting your credit card forever.
That's exactly how it works. It's a classic subscription trap. And because you need multiple apps to make a store fully functional, those costs stack up rapidly. Our sources show that a moderately functional store easily spends between $70 and $554 every single month just on app subscriptions.
Just on apps. That's insane. It's like buying a smartphone, but it doesn't even come with a camera or messaging app. You have to rent those basic features month by month just to make the store function like a normal 2026 website.
Yeah, that's a perfect analogy.
And that doesn't even cover the aesthetic side of the site, does it? The way it looks.
No, it doesn't. Which brings us to the third major cost center, which is themes and customizations.
Okay.
A premium professional-looking theme will cost you anywhere from $180 to $400 upfront.
Okay, that's a one-time fee though, right?
Well, the upfront cost isn't the real trap. The trap is maintenance. Whenever the main platform pushes a major core update, it has a really high probability of breaking your custom theme code.
Oh, wow. So you wake up one morning and your checkout button is just floating in the middle of the screen or something.
Exactly. Or the images won't load. So now you have to budget $100 to $300 a year for developer maintenance just to patch the code and keep your site from crashing when a customer tries to click add to cart.
Man. Okay, so we've paid for the site, the apps, the design, and the payment processing. Now a customer actually buys something. I have to physically send it to them. And reading this part of the research, my jaw absolutely dropped. Walk me through the shipping surprises, specifically this concept of dimensional weight.
Oh yeah, this is a classic supply chain shock for new merchants. It honestly wipes out thousands of businesses in their first year.
I believe it.
Carriers like FedEx, UPS, or DHL, they charge based on either the actual physical weight of the package or its dimensional weight, whichever is higher.
Okay, and dimensional weight is?
Dimensional weight is a calculation based on how much physical space the box takes up in the back of the delivery truck.
So if I'm selling a delicate 1-pound lampshade.
Right, the lampshade only weighs 1 pound, but to protect it, you have to pack it in a 12 by 12 by 12-inch box full of bubble wrap.
Yeah.
The carrier's formula looks at that box size and calculates its dimensional weight at, say, 12 pounds. You are now paying the shipping rate for a 12-pound item, even though it only weighs 1 pound.
That is brutal. It's essentially paying for air. And if the customer doesn't like the lampshade and sends it back,
then you are absorbing another $5 to $12 in return shipping costs.
Which completely wipes out the profit of the next 3 sales you make. You're effectively paying money to have a lampshade take a round trip across the country.
Exactly. It's a massive profit leak.
And then, just to keep the government happy, we have the 5th hidden cost, tax compliance.
Right. Navigating the maze of U.S. sales tax across 50 different states or dealing with international VAT, it isn't something you can easily do manually on a spreadsheet anymore. The laws are simply too complex and they're constantly changing.
Right, you can't just wing it.
No, you can't. So merchants are functionally forced to buy dedicated tax software subscriptions, which adds another $19 to $99 a month to their structural overhead.
Just to calculate the taxes. And here's the kicker. You've paid all these fees, and you still have to actually get people to look at your website.
Yep.
Which leads us to the 6th major cost, marketing and customer acquisition costs, or CAC. Why has this gotten so incredibly expensive lately?
It's a confluence of factors, really. Data privacy updates across major mobile operating systems, they've made it much harder to track users, which means algorithms are less efficient at targeting ads.
Okay, so the ads are less effective.
Right. Plus, the sheer saturation of digital ad space means you are bidding against millions of other merchants. Depending on the channel, acquiring a single new customer today costs between $15 and $50.
So think about that math for a second. If your product only yields $20 in gross profit, and you paid $25 to Facebook or Google to get that customer, you are mathematically operating at a loss from the very first click. You are subsidizing your own customers.
You absolutely are. You're paying them to take your product. And finally, the absolute salt in the wound, the 7th hidden fee, chargebacks and fraud.
This one feels particularly unjust.
It is. It really is. If a customer disputes a charge with their credit card company, maybe they claim it was unauthorized or the package was stolen off their porch, Shopify assesses a $15 penalty fee to the merchant just to investigate the dispute.
Wait, win or lose?
Win or lose, just for the process
You're
occurring.
kidding.
No, and if you lose the dispute, you lose the physical product, you lose the revenue you thought you made, and you still lose that $15 fee. Not to mention the operational time you wasted fighting it.
It's like buying a car based on the sticker price. But when you go to drive it off the lot, the dealer tells you the steering wheel is a $50 monthly subscription. The doors are an extra $20, and the brakes, well, the brakes are going to cost you 2% every time you use them. It's death by 1,000 paper cuts.
That's the SaaS model in a nutshell.
So what does this all mean for someone just starting out? Let's take these concepts out of the abstract and apply them to a real-world scenario. Let's say a merchant is doing a solid $10,000 a month in turnover on Shopify. Let's do the real math step by step.
Okay, let's do it. To have a store that functions properly at a $10,000 monthly volume, you are likely on the Shopify Grow plan, which is about $105 a month.
Okay.
Right off the bat, basic payment processing on 10K takes about $290.
Okay, so out of our 10,000, we're already down nearly 400.
Right. Now, let's say you operate in a region where Shopify payments isn't supported, so you have to use that external gateway we talked about.
Right, the penalty.
Boom. That 2% penalty vanishes another $200 immediately. Then we add in the app bloat. For basic features like multi-currency, a loyalty program, decent email marketing, and those product reviews, you are looking at conservatively $150 to $300 a month. Let's add another $100 to $150 for currency conversion and miscellaneous fees.
Let me just add that up. So 105 for the plan, 290 for processing, 200 for the penalty, let's say 250 for a modest app stack, and 150 for currency. That is essentially $1,000 stripped directly from the business owner.
Exactly. And remember, the SaaS model doesn't care about your cash flow. Even in a vacuum with 0 sales in a given month, those app and platform subscription fees still trigger.
Oh, man. Yeah.
But with 10K in sales, you lose roughly 10% of your gross turnover to platform infrastructure before you have paid for your physical goods, before you have paid for a single ad, and before you have paid for a cardboard box or shipping. This infrastructure model fundamentally kills small business profit because it scales your fixed expenses faster than your profit margins can keep up.
And I noticed there's another cost in the sources that doesn't even show up on a credit card statement. They call it the app performance tax. I'm not a developer, so explain to me why adding a simple review widget to my site actually hurts my bottom line in ways I can't easily see. Shouldn't it just be a simple visual plugin?
Well, this raises an incredibly important question about how website architecture directly impacts consumer psychology. It's not just visual.
Okay.
Every single third-party app you install injects its own JavaScript code into your store's underlying framework. All these different apps are calling out to different servers, trying to load simultaneously. This severely bloats the site's code and drastically slows down page load speeds.
So it's like putting 100 heavy boxes in the trunk of a sports car and wondering why it doesn't accelerate.
Perfect analogy. And our sources point out a brutal, measurable metric on this. Every 1-second delay in page load time drops your overall conversions by 7%. 7%. So by trying to make your store look professional with 10 different fancy apps, you're actually slowing it down so much that customers get frustrated and leave before the checkout page even loads.
Yep.
You're paying monthly subscription money to actively lose sales.
Precisely. It is an invisible structural tax on your conversion rate that most merchants never even diagnose. They just wonder why their ads aren't working.
Wow. Okay. Since this traditional SaaS model clearly punishes growth with these layered fees and bloated code, what does a fair ecosystem actually look like? Because this brings us to EXMON Bazaar. I want to pivot entirely to the benefits of starting a business over there, because the contrast in the source material is staggering.
It really is night and day.
Let's compare the core philosophy, starting with the baseline commissions and those app costs.
The first major difference is the total elimination of the subscription model. EXMON Bazaar completely removes that $100+ monthly baseline fee. There is no rent to pay, just for having your virtual doors open.
Secondly, they solve the app bloat issue and the JavaScript speed issue we just talked about by building the essential e-commerce features directly into the core platform architecture.
Meaning you don't need third-party developers patching things together.
Right. Multi-currency, deep store analytics, unlimited product uploads, whether you are listing 3 items or 50,000 items, it all works out of the box for free.
That's huge.
Because it's native to the platform, there's no JavaScript bloat slowing down your site, and no patchwork of third-party subscriptions draining your account.
And let's talk about that 2% difference, because to me, this is where the philosophy of the two platforms really diverges. Shopify charges a 2% penalty on top of your standard processing fees just for not using their proprietary gateway.
Yeah.
EXMON takes a totally different approach to that number, right?
It is a complete inversion of the business model. EXMON Bazaar operates on a simple, singular rule. They take a flat 2% commission after a successful transaction. That's it.
After, okay.
Yeah. There are no cascading penalties. If you don't sell anything this month because you are redesigning your product line or waiting on a shipment from a supplier, you pay absolutely zero to the platform. They only make money when you actually make money.
So let's run that exact same $10,000 net profit comparison we just did for Shopify. If a seller turns over $10,000 on EXMON Bazaar, exactly $200 goes to the platform, period.
Right.
Compare that to the nearly $1,000 that vanishes into the Shopify ecosystem between subscriptions, penalties, and processing. We are talking about $800 in extra retained cash monthly. That's nearly $10,000 annually going straight to the seller's net profit.
And if we connect this to the bigger picture of survival, for a small business, a few $1,000s in retained earnings is often the very literal difference between being able to afford a new inventory run for the holiday season or having to close up shop entirely.
Absolutely. Here's where it gets really interesting. But wait, I have to push back a little here on behalf of our listeners. The sources note that EXMON operates heavily in the Web3 space, utilizing crypto, specifically USDT, for settlements.
Yes, they do.
For a lot of traditional e-commerce folks listening right now, crypto sounds like the absolute Wild West. They hear crypto and they think wild price swings, scammers, and lost funds. How does EXMON address the volatility? And what happens if a buyer claims they never got the product?
That is the exact friction point for many traditional merchants transitioning to Web3 commerce, and it's a totally valid fear. But EXMON has engineered a very secure, stabilizing solution. First, regarding volatility, USDT is a stablecoin.
Okay.
It is pegged one-to-one to the US dollar. It doesn't swing wildly in price like Bitcoin. A dollar is a dollar.
Okay, that solves the volatility issue. But what about the scammers? You know, the standard hit and run where they buy a product and then cancel a payment or something?
To solve that, they utilize a strict smart contract escrow system. Think of a smart contract like a digital, completely impartial vending machine.
A vending machine.
Yeah, when a buyer makes a purchase, those USDT funds do not go directly into the seller's wallet where they could run off with it, nor does the buyer keep control of it. The funds are locked in the digital vending machine. The smart contract physically cannot and will not release the funds to the seller until the tracking code or the buyer confirms physical receipt of the item.
Oh, wow.
It completely neuters the standard hit-and-run scam because the money is secured up front but safely held in the middle.
Okay, I like the vending machine analogy. That protects the transaction itself. But what about the origin of the crypto? Nobody wants their corporate exchange account frozen because some random buyer halfway across the world used flagged illicit crypto funds to buy a t-shirt.
Right, and this is where EXMON's specific architecture really shines for serious businesses. You, as the merchant, are never receiving crypto directly from a random buyer's personal wallet.
You aren't.
No. EXMON processes the transaction into the escrow, and when the transaction is complete, EXMON pays you out from its own centralized, heavily audited corporate wallets.
Oh. So there's a buffer.
A massive buffer. This guarantees that the crypto you receive is mathematically clean and completely AML, anti-money laundering compliant. There are no dirty money tags attached to your funds because they are coming directly from a vetted corporate treasury.
So you avoid the bureaucratic nightmare of frozen bank accounts and SWIFT network sanctions entirely, which is a massive, massive headache for international sellers trying to operate on traditional platforms.
Absolutely. Web3 infrastructure, when applied correctly, removes the friction of cross-border commerce. And regarding your earlier question about disputes, EXMON doesn't rely on automated bots that blindly rule in favor of the buyer just to save the company time, which is what we see on traditional platforms all the time.
Right.
They use live human support teams to investigate disputes, looking at shipping weights, tracking numbers, and evidence from both sides. It's a much more equitable system for the merchant.
That makes perfect sense. The transparency actually protects both sides. So we've diagnosed the disease of the SaaS model, and we've looked at the cure with EXMON. Let's move to some immediate, actionable survival advice for the entrepreneurs listening who are operating in today's incredibly tough market. Your sources highlight something called the 90-day audit. Break that down for us.
Sure. So the 90-day cost audit is the ultimate survival tool to stop profit leaks, regardless of what platform you are currently on today. Every 90 days, you must export your entire billing history into a spreadsheet.
Okay.
You then ruthlessly audit the return on investment for every single app or subscription you have installed. The rule is binary. If an app is not directly making you measurable money or saving you measurable time, you uninstall it immediately.
So no emotional attachment to that cool pop-up spin the wheel game that nobody actually engages with.
Exactly. It's slowing down your site and costing you $20 a month. Cut it. The final, crucial step of the audit is calculating your effective payment processing rate. You take the total processing fees you paid for the quarter and divide it by your total gross revenue. Merchants are often deeply shocked to find their effective rate is hovering around 6 or 7%, not the 2.9% they thought they signed up for.
Ouch. And once they know those numbers, how do they know if their business is actually healthy? You mentioned a framework in the notes called the rule of thirds.
Right. The rule of thirds is a golden baseline for healthy unit economics. Your total revenue should roughly split into 3 equal buckets. 1/3 goes to your product costs, so manufacturing, sourcing, and packaging. 1/3 goes to operating costs, your platform fees, your apps, shipping, and marketing.
Right.
The final third should be your gross profit. If those hidden operating costs we've been discussing are swelling and eating into that final third, your business model is mathematically unsustainable over a long timeline.
So what does this all mean? It means controlling these hidden fees from day one is literally the only way scaling up actually equals more profit. Otherwise, scaling just means you are multiplying your overhead, increasing your stress, and working twice as hard for the exact same amount of money. If your margins are fundamentally broken at $10,000 a month, they're going to be an absolute disaster at $100,000 a month.
Exactly. Scaling a broken system just breaks it faster.
This has been incredibly illuminating. We've covered a massive amount of ground today, from dimensional weight to smart contracts. But before we wrap up, I want to leave our listeners with something fresh to chew on. Based on everything we've analyzed about this shift from traditional SaaS to Web3 models like EXMON, where is this ultimately heading?
Well, if we look at the trajectory of these technologies, it raises an important, almost radical idea. As Web3 commerce matures, we might be moving toward a future where the rigid lines between merchant, buyer, and platform begin to dissolve entirely.
Dissolve. How so?
Imagine a marketplace where active sellers and loyal buyers don't just pay fees, but actually earn equity or governance rights in the platform itself through tokens. Instead of just renting space from a tech giant, the community that generates the value actually owns a piece of the ecosystem they are building.
Wow.
That alignment of incentives could completely redefine what it means to be an entrepreneur in the digital age. It's something to think about as you audit your stores this week.
A marketplace owned by the people actually doing the selling. That is a brilliant and truly provocative thought to leave off on. Are you building a business or are you just paying rent? Thank you all so much for tuning into this deep dive. We really appreciate you spending your time with us, parsing through the real math of e-commerce. If you enjoyed this breakdown and found it valuable, please leave a like on the video. And don't forget to subscribe to the EXMON Global channel. Make sure you hit that bell icon so you get notifications for our next release. Until next time, keep your margins high, your load speeds fast, and your overhead lows.